Good morning, everybody. This is Stephanie over here at AIM. We're going to be starting our Lincoln MoneyGuard 3 webinar in just a few minutes. Go ahead and get yourself situated, get yourself some coffee, and we'll be going in just a minute. Good morning, everybody. Again, this is Stephanie Paul with Stephen Denton from Lincoln MoneyGuard. We're going to be talking about MoneyGuard's newest product, MoneyGuard 3. This does exclude California and New York, but we will be starting in just a minute. So go ahead and get situated. Just wanted to point out that we do have another webinar next week, Tuesday, November 12th at 9 a.m. Pacific Standard Time, and it will be Mastering the Mutual of Omaha Long-Term Care Software with yours truly. So we'll be starting here in just a minute. Everyone will be muted so we don't have any distractions. At the end, we will be asking any questions. So if you want to just either submit the question on the GoToMeeting, or you can just wait to the very end. People logging in, I'm just going to wait a couple more minutes and I'll let Stephen take control. All right, we'll just get started as people are logging in. We will have it recorded, so at any time if you need to revisit this, just go ahead and give AIM a call, and one of our marketers can gladly get the recording over to you. Stephen, are you there?
Yes, I am.
Thank you so much for taking the time to go over this product. I have had a lot of calls on it, and so I'm very thankful for you to take the time to go over it with us.
It is my pleasure. Thanks for having me on, and thanks for tuning in, everybody. What we're going to go over today is MoneyGuard 3. We're going to cover the financial challenge, the options for planning, flexibility, and then some of the clients within the book of business or within some of your advisors' books of business that will be able to take a look at MoneyGuard 3 to basically help their financial plan pay for cost of long-term care. My name is Steve Denton. I am an internal wholesaler, and I have been with Lincoln for the last 12 years. And in that entire time, I have been with MoneyGuard. When I first started, we were doing about $300 million in premium on an annual basis. Since then, we have grown to be a billion-dollar business. And in 12 years, I can say that the highest I think we've seen it is $1.8 billion as far as premiums paid into this solution. And so what that suggests is that, people want to talk about it. People are being forced to talk about it because of experiences that they've had. And, not only a financial challenge that we see here in front of us, whether it be in-home care, assisted living, or nursing home, but just, situations where they have a friend or, a grandmother or a parent that you have to take care of, and everything that goes along with it, whether it be the financial challenge or the emotional challenge, the physical challenge. All these things kind of weigh into long-term care. And, with the statistics that are facing us, as far as 1 out of 2 Americans turning 65 will most likely need some form of long-term care in their lifetime, and 20% of people 65 and older will need long-term care for 5 years or longer. So that's part of the financial challenge. And again, here are some of 3 of the most common care settings for long-term care, whether it be in home, which is, popular. A lot of people, don't want to have to go to a facility, but the likelihood of somebody coming in home, whether it be a loved one or a professional, to provide that in-home care, your condition may worsen, and in-home care might not be the right strategy. So you may be forced into assisted living or nursing home. And with that, we also have to think about cognitive impairment. There are about 5.1 million Americans that suffer from Alzheimer's, and that was a stat in 2015. They're projecting by 2025 that 7.1 million people will be suffering from this disease. And I think that's really what leads to that 20% of the 65 and older that might need long-term care for 5 years or more. I mean, think about the numbers that are in front of you. If you're in a nursing home, if you do have Alzheimer's or some form of dementia, right now the national average is about $105,000, and that's the national average. This could be, more depending on where you live. Could also be less, but if we're just taking the average, if we're saying 3 years in a nursing home, which is a statistic that a lot of people like to use, what happens if you do have this Alzheimer's condition that may make you stay in long-term care claim for more than 5 years? We're looking at an expense of $500,000. Are you prepared for that expense? You can see that, in-home care is running about $4,000 a month as a national average, and then, assisted living is a little bit more. So you can see the cost is quite considerable. And without a plan in place, you may be turning to some alternatives, or you may think that there are other things that are going to help you that you may not be aware of. So let's talk about those options for planning. A lot of people think that Medicare is going to cover it. Medicare is not going to cover an ongoing long-term care need. Medicare covers short-term or limited coverage, and that's usually going to be for medically necessary in a nursing home or home health care situation where you've had 3 days or more in the hospital. So Medicare, again, once it gets past about 100 days, you're on your own because now that's ongoing care and Medicare is not going to cover your long-term care need. Medicaid can. The thing with Medicaid is that it's a government program, and the government program is for people that can't afford and have very, very limited means. So the options for Medicaid is your financial plan has to be to spend down your assets. Now, I don't know anybody that goes to their financial advisor and says, yes, I want to spend down all my assets so that I can be taken care of by the government in a care setting that I'm not in charge of anymore. That's not the best plan. So I would think for anybody that has a financial advisor, Medicaid is probably last on the list. A lot of people feel like family is going to take care of them. Now, the thing with family is that, yeah, it might start off that way, but you have to think about the person at home and if they can really provide the care. I mean, if you think about it, if your husband is, 250 pounds and, and your wife weighs less, is she really going to be able to substantially help this person out of bed, help them in the shower, dress them, feed them? The physical part of it is something that I don't think a lot of people actually stop and really ponder if it's doable. But then you have to think about, if it's somebody that maybe can physically handle it, maybe it's a son or daughter. What about their wages? Are they going to be missing work? Lost wages for them, the emotional toll on taking care of somebody deteriorate within your family. So, it's a plan that a lot of us think that, we may fall back on. But when you actually really think about, what you may be doing to the people in your family, both financially, emotionally, and physically, it may not be the best plan when you think of it that way. The most popular solution is traditional long-term care. Traditional long-term care has been a solution in America, and it's probably what most people think of when they think of long-term care. It does cover long-term care expenses, but it does have a few drawbacks, and we'll talk about that in a minute. The newest solution that's been out, for the last, in MoneyGuard's case, 30 years, has been a hybrid solution. And what that is it's not just a long-term care product, but it comes in the form of life insurance. And the whole purpose of it is to take care of that long-term care need, but then also offer additional benefits in case long-term care doesn't happen. So what about traditional long-term care? We just talked about that a second ago. It's probably the most popular solution that's out there, and there's, it does hold a lot of benefit to somebody that does own it. But if we're going to talk about it as a solution, we have to talk about, all of the maybe drawbacks or some of the negatives that go along with, reimbursing your long-term care expense. I always say, and I'm sure a lot of people on the call know, that traditional long-term care works a lot like car insurance. I'm sure we've heard that 100 times, right? You pay your premiums. If you ever have the need, the insurance will pick up and cover the cost of what you've been paying into it. But if you think about it just like a car, if you never have that car accident, but you've been paying car insurance your whole life, what did it really purchase? Well, it purchased peace of mind. So that's kind of what traditional long-term care does. But it does have that use it or lose it. So if I never use the insurance, I am paying for peace of mind. Now, the other thing that goes along with it is that these premiums are not guaranteed. So I'm sure we've all heard in the news the rate increases that have been happening over the years. We are looking at possible premium increases. Not only that, but we don't know when we're going to need long-term care. Sure, it may happen sometime after the age of 65, but we really don't have a crystal ball to tell us when we need it. So I might be paying premiums for a very long time that, again, aren't guaranteed. But then when I need the care, when I need the insurance, I have to pay out of pocket for my elimination period. That could be 30, 60, 90 days, depending on how you structure your policy. So that leaves a lot of people saying, well, you know what, I'm not really in favor of that strategy, so why don't I just self-insure? But a smarter alternative to self-insuring is the hybrid products that we talked about. So what we can do is we can provide tax advantage reimbursements for qualified long-term care expenses, but after the long-term care reimbursement of a tax-free nature, we can offer additional benefits. So if you never need that long-term care, if you're lucky enough to be one of those people, there are additional benefits that you can fall back on that get over that use it and lose it scenario. We can feature premiums that are set at issue. What does that mean? They're guaranteed. So I don't have to worry about increasing premiums because of what's going on in the insurance market. And it has no elimination period once eligible for benefits. So that means I can get the benefit as soon as I am able. What are we talking about? Well, we're talking about Lincoln MoneyGuard 3. We've always hung our hat on the way to describe it, which is this little catchphrase underneath, which is a smarter alternative to self-insuring. One of the things that we talk about, and it's always been the story with MoneyGuard, is people that want to self-insure. You know what we say to that? Great. That's why we're showing you this. We're showing you this because we want you to self-insure. We just want you to self-insure with MoneyGuard. What we want to do is we want to take the money that you have right now that you're self-insuring with and just take a portion of it. And let's put it into MoneyGuard. And what are we going to get? We're going to get the 3 piggy banks that we see in front of you, which are, number one, the need for long-term care. We are going to take every dollar that we give you, and based on your age, your gender, and your marital status, we are going to give you a multiplier. We are going to give you tax-free leverage for long-term care. And that is going to be the number one priority for MoneyGuard. But if you don't use the long-term care, we have 2 additional benefits that we can fall back on. One of them is a tax-free death benefit. Now you can see the piggy bank is a little bit smaller than the long-term care, and that's because it's not the same value. What we're going to do is we're going to give you a little bit of leverage on your money for the life insurance, but it's going to come back to you tax-free. So there, you have guaranteed on investment. You're either going to use it for long-term care, or you're going to give it back to your family with a little bit of leverage on a tax-free basis in the form of a death benefit. So that money did not go anywhere. But while you own the policy, you also have return of premium options, which if you have control of the asset, you are self-insuring. And you get to choose. Do you want to do one of 2 options for return of premium? Do you want to do the base policy, which we call option 1, or the graded? And let's dive into that a little bit further. The base policy, or option 1, which we like to call basic, that's our terminology that we use here at MoneyGuard. It's a 70% return of premium. Now, we're talking about MoneyGuard 3 now. If we circle back to MoneyGuard 2, there was a difference there. We were doing 80% return of premium before. Now we're dropping it down to 70%. Why? Interest rates. Interest rates right now are at an all-time low. And so we have to make changes to make sure that we can stay in the game and offer your clients the money that we're promising them when the time's for claim. Now, one of the options that is very minimally utilized is the return of premium. In the history of MoneyGuard, which has been 30 years, less than 2% of all policyholders have ever exercised return of premium. It creates the identity of self-insuring because I'm not losing that asset. But it's really just a comfort. I can get this money if I need it. I'm not purchasing this to get my money back because I'm not getting any growth. I'm actually losing 30%. What am I getting? I'm getting tax-free long-term care leverage, and I'm getting leverage on the life insurance on a tax-free basis as well. But with some of the changes, because we want to be here and we're going to be a company that's going to offer this product for a long period of time, we're not getting out of the market. We do have to make some changes because of the interest rate environment, and this is where we felt would be a good place to kind of draw back. We're still going to offer that 100% return of premium, as you can see with option 2, which we call graded. But our vesting schedule has now been extended. It used to be a 5-year vesting schedule. Now we're doing a 10-year vesting schedule where at year 11, you are 100% full return of premium. Now, one of the options that we have changed with our return of premium, we call it first dollar return of premium, right? Reduced barriers. That's the technical term that we're using. And that goes to option 1. With our return of premium features, it always had to be that we needed to receive every dollar of premium before we would give you that 70%. So if you're not doing a single premium option, if you're doing a 10-pay option, we had to receive all 10 payments before you would get that 70%. We no longer do that. Because we're dropping down the basic return of premium from 80% to 70, we're going to give you 70% of every dollar we receive. So if you were doing a 10 pay and you're doing $10,000 a year for 10 years, if you make one payment of $10,000 in year one and then you decide to exercise your return premium, you walk away with $7,000. Is it related to MoneyGuard 2? You would walk away with nothing, maybe a couple $100 if you were lucky. Because in MoneyGuard 2, we needed to receive all premiums first before we would give you that 80%. Now with the 70%, we're going to give you 70 cents on the dollar. So just a little change there to our return of premium, but still a feature that you can have. Now, we are a reimbursement product. We have always been. And that is something that we take pride in because we have a lot of success in our claims scenarios where we can reimburse the provider directly. Yes, you do need a receipt, but the receipt can be sent to our claims manager, which you will only have one when you go to claims, and we can electronically reimburse that provider directly, thus making the owner of the policy or whoever is controlling the insured's affairs have to do all the paperwork themselves. So a reimbursement strategy, we do require that a licensed healthcare practitioner certifies that you are chronically ill. What does chronically ill mean? It means that you can't do 2 of the 6 activities of daily living for 90 days or longer. Now, what's the key word in that sentence? It certifies. You don't have to wait 90 days. If you're a licensed healthcare practitioner will certify that you will be chronically ill for 90 days or longer, you are eligible for reimbursement. With no elimination period, that could be immediate. If for some reason you experience some sort of care before your licensed healthcare practitioner certified, we will reimburse and backdate 12 months prior for any cost that you may have had. We also will reimburse for cognitive impairment. Also, if your licensed healthcare practitioner certifies that as well. We do, every 12 months, we'll visit with the licensed healthcare practitioner. We got to shorten that up. Just to confirm that, everything is still, because you may improve, your condition may improve. And that's okay with MoneyGuard, because if you go on long-term care claim and then come off of it, you are still eligible for the remaining benefits inside of MoneyGuard. So this is not a chronic illness rider where your condition has to be permanent. You can come on and off claim with MoneyGuard. So that's important to know when you're differentiating between other products. And a plan of care is what we require, which is pretty much industry standard. I mean, you're going to have a statement of loss, you're going to have a plan of care, and then you'll be eligible for the benefits that MoneyGuard offers. So just want to make sure you are aware of that as we move on to some of the people that may qualify. Now, this is something that is in almost everybody's book, and a lot of it isn't, anything that you haven't heard before, but it's good to revisit. MoneyGuard does require non-qualified assets. So the cash-strong client has been the demographic that built our success over time. And so these people can do the single premium, right? They have a lot of cash on the books. They're selling a business. They're selling a home. They have CDs about to mature. We can take that, just do a reposition, right pocket to left pocket, get the long-term care life insurance return of premium benefits that we talked about. And, it's a set it and forget it. And, we'll take care of long-term care down the road. It's not something that they have to keep making payments on, but they will see their annual statement and see how the inflation adjustment grows over time. So, it's something that, while it's only one transaction, it will be serviced until the time of need. Our pre-retirees, these are the people that we actually focused on over the last, I'm going to say 5, 6, 7 years, and diversified our book. We're not always pushing the single premium. Yes, it will give you the most benefit, as we'll see when we take a look at some numbers, but it may not fit your budget. Not everybody has that nest egg. Not everybody has that single premium reposition that we can put into it. So we can spread out payments. With pre-retirees, we can do 5, 10, 15 years. We have a pay to 70 now with MoneyGuard 3. So depending on your age, you might be able to do a 20 pay. And we're going to take a look at some examples in a few minutes. Our issue ages are going to extend. With MoneyGuard 2, we were 40 to 79. With MoneyGuard 3, we're going to be 30 to 80. Um, so, um, our retirees that have IRAs and have to take those RMDs, or they have annuities, we can reposition that into a 3, 4, 5, 6, 7, 8, 9, 10 pay, and kind of take some of the income that is disposable, that they don't necessarily need, and reposition that into a long-term care solution. And then our growing demographic is our young professional. Our young professional is somebody that is a higher income earner, somebody that can take a couple of $100s and stash it aside because, someone like me. I'm 43 years old. My mother's 80. I'm the youngest of 6 kids. My mom is, she's still on her own. She's still independent, but, a lot of my aunts and uncles have experienced long-term care needs. Luckily my mom's not there yet. But, just knowing that that's near, it makes me think about what I would do if it were to happen to me and how that would affect my children, my wife. It's a concern. When you have that experience, it's something that, you may want to get a jump on. And the younger you think about it, the more money you save. Again, all of our benefits are based off age, gender, and marital status. So, the younger you look at this, the less premium you'll pay, the more benefits you'll get with compound inflation. So let's take a look at an example. We're going to take a look at Susan, age 60. She qualifies for couples discount. That is the only thing that will affect benefit. You're either married and you get the couples discount, and that includes domestic partnership, that includes civil union, same-sex marriage, common law marriage. If it's registered at the state level, Lincoln will honor it. If you do not get the couples discount, then we're just going to call you standard, which means you're single, widowed, or divorced. She has the same concern that everybody else has. Can an illness deplete her savings that she's taken a long time to grow? So we're going to take a look at a MoneyGuard. Now she's going to put in $100,000. She's going to take that CD that's sitting at the bank and she's going to turn it over to MoneyGuard, and let's look at what she's going to get. She is going to get immediately $472,000 for long-term care. Now that's, a little bit under 5 to 1 on the dollars that she's putting into. That's going to turn into a monthly maximum of about $6,500 for her long-term care expenses. Now, with that, we're most likely going to put an inflation rider on it. We're going to see that grow over time. So this is starting dollars that, can keep the cost with maybe in-home care or assisted living. Maybe where she lives, that'll cover nursing home as well. But, whatever care setting it may be, the MoneyGuard long-term care reimbursement is going to cover. If she were never to use that long-term care and were to pass away, $170,000 of tax-free money will go back to the family, thus guaranteeing return on investment. And most options that you will see is the 70% return of premium. You will see that, for some reason, if she were to need to surrender the policy, she would walk away with $70,000. Now, what if she doesn't want to do a single premium? What if she wants to look at a 10 pay? Well, you can see that the 10 pay is adjusted, right? You're not getting the same initial benefit that you're getting on the single pay, but you will get all 3 benefits on a tax-free basis. You'll get the long-term care. You can still see that's the primary benefit. We dropped down to maybe 3.5 times as opposed to just under 5 for the reimbursement. You get the $130,000 tax-free death benefit should you not use the long-term care. And again, you get $70,000. Now, again, remember what I said. With the new return of premium option, you get 70 cents on the dollar. So any dollar that's paid in, 70 cents gets returned to you. So if you made 2 payments of, $20,000, you're walking away with $14,000. So keep that in mind as one of the changes from MoneyGuard 2 to MoneyGuard 3. Now let's take a look at Victor and Gail, both the age of 50. So they qualify for the long-term care couples discount. Possible concerns, they were holding off on funding their long-term care because they had kids that were going to college. So they were funding their 529 plans. But now that the kids are in college, they can take a look at a 15 pay and take a look at the benefits that they can get. So if we're going to forecast ahead just to see what the inflation does, if Victor pays annual premiums of about $9,200, by the time he is 84, he's going to have $1.2 million for long-term care, which would identify as $16,391 in monthly long-term care benefit. If you didn't use the long-term care, you would return $156,000 tax-free back to Gail. And again, with that base option, you get $97,000. Now, let's take a look at Gail. If Gail does the same strategy with the same benefits, you can see that her premiums are going to be a little bit more. Now, the reason for that is because of long-term care risk associated with women. Women go on claim a little longer. They go on claim more often. So if you ever have a husband and wife at the same age, you will notice that the female's premiums are going to be a little bit more expensive. But again, excellent use of the flexible pay strategy and the fact that they didn't have or maybe didn't want to reposition that lump sum. It's more comfortable to pay over time, and you can see the return on investment both with long-term care. For both of them, it's really going to take care of the need when that does arise a few years down the road. Now, I was telling you that our up-and-coming demographic is our young professionals. So let me just show you a strategy for Ryan, who's age 40. Like me, he's got a couple of kids. He's aware of what long-term care can do because maybe he's got an experience in his family. And wants to look ahead and maybe take the burden off his children. So with him, he's going to pay about $4,800 in annual premiums. Really what that is $400 a month. That fits his budget. With the compound inflation that we can offer with our new MoneyGuard 3 product, you can look at $2.1 million when he gets to be about 84. So 44 years down the road, $4,800 of annual premiums over 25 years have amounted to $2.1 million. Again, that's tax-free. If he does not use it, stays in the family again, tax-free death benefit, back to his wife, back to his kids, whoever he wants to leave as his beneficiary, and then again has the option of return of premium with 70 cents on the dollar. So you can see no matter the strategy, no matter how you fund it, long-term care first, life insurance second, return of premium third. So some of the prospective clients within your book, we kind of went over briefly with the quadrant flyer, but highly compensated professionals, they get more leverage when they're young and healthy. The sandwich generation, which is, they're paying children's tuitions or maybe paying for their parents' long-term care expenses. Find a strategy, find one of our flex pay strategies that fits their budget. Clients nearing retirement, they might have financial flexibility with annuity funding, so different income streams that are coming in through, their retirement. They can use a flex pay strategy to take care of the long-term care aspect and protect the other assets inside their portfolio. And again, nobody wants to pay taxes, especially those that have money or those in retirement. So we can spread out the tax responsibility with some of those RMDs and funding a flex pay strategy there. So you can see single females we talked about, clients in or near retirement. They want to, they're worried about the rising health care. They don't want it to deplete their savings. So, all these people are the situations that we've looked at, people within your book that all fall into those four quadrants, and can be specific to your personal book. So after going through this, why MoneyGuard, why Lincoln? So I've told you that we're going to be 32 years old this year. MoneyGuard is the leading hybrid solution. We still control about 60% of the market share for hybrids. It's backed by Lincoln. Lincoln's company has been around since 1905. Has tremendous financial strength. It's posted all over our websites. Again, we're not in it for 30 years and looking to get out of it. We're looking to sustain this business, which is why we're making these changes, which is why we're having the evolution of MoneyGuard. When I started, it was MoneyGuard Reserve. They went to MoneyGuard Reserve Plus. They went to MoneyGuard 2. Now we're at MoneyGuard 3. So the product's evolving, and we're staying competitive as the leading hybrid solution. You have internal and external support. Larry and I work very closely with Mike and Stephanie to provide you all of the information that you need about MoneyGuard. But last but not least, our claims paying excellence. This is something that we take very serious at MoneyGuard. We have a concierge care program that you are able to use at issue. If you look at our competitors, you get to use them at the time of claim. We let you use them at issue. It's extended not only to the owner, but the insured, of course, and then any family member that you want to be a part of this solution. We can show you how to plan for it as far as services in your area. We can let you know updated costs in your area with heat maps all throughout the country that break it down to county, to a metropolitan area. We have articles, we have assessments. So this Silver Brick Road that we use, our concierge care program, is definitely an immediate benefit that helps you start the planning, and it gives you an idea of what you can expect in the future. So, I mean, just as far as some of the other changes with MoneyGuard 3, we are offering now a terminal illness rider, which lets you use 75% of the death benefit if you're diagnosed as terminally ill. So that is a feature that we did not go over in the PowerPoint, but it's something that's it's actually available in the New York version of MoneyGuard. We decided to add it to the rest of the country with MoneyGuard 3. So if you're diagnosed as terminally ill, which means you have about 12 months, you can basically borrow on your specified amount of your guaranteed death benefit, those figures that we were showing earlier, up to 75% of it. And then, you know, obviously anything that you use for that, there wouldn't be any long-term care left. So conversely, if you turn on long-term care, you don't have access to the terminal illness rider. So keep that in mind. We did talk about the issue ages being extended to 30 to 80. And one thing that I do want to talk about is our transitional care assistance benefit. This is a new covered service that helps clients transition from informal care to formal care. And what it does is it allows for 100 days up to, it's $100 a day up to the first 180 days of claim. It's got to be in year one, but it doesn't require any receipts. So this is for somebody that, you know, is maybe getting in-home care 5 days a week, and on the weekends, you know, there's a daughter or even the spouse or anybody, could be a friend or you know, neighbor, whoever it may be. They can come in and provide care up to 180 days, and you don't need any receipts for it. It just needs to be written in the plan of care by the physician that this is part of your long-term care solution. So you'll have in-home care for 5 days a week by, you know, a nursing agency, and then you're going to have this transitional care assistance 2 days a week from, you know, a family member or friend, or however that shapes itself out. But it's kind of MoneyGuard's attempt to dip our toe into the indemnity feature. Now, we do believe that reimbursement is the way to go about it. That's Lincoln's stance on long-term care. Reimbursement is the way we want to go. But we do realize that other competitors are in the market, and a lot of people are looking at indemnity. So we figure we would just kind of offer this as a little sweetener. Again, in the first year of claim, up to 180 days in that first year of claim, and it's $100 a day with no receipts. The last thing I'll mention before I kick it back over to Stephanie is our international benefit is now 36 months. It's a flat 36 months, and it doesn't have to be in the first 3 years of long-term care claim, which is different than MoneyGuard 2. If you remember MoneyGuard 2, we had 2 riders. One of them was the acceleration rider. The other one was the extension. We've kind of done away with all that. MoneyGuard 3 is now just 1 rider, so that LABR rider doesn't dictate what the international benefit is anymore. The international benefit is just 36 months that can be used either in the beginning years of claim or the ending years of claim, depending on how that works out for you, if you want your long-term care needs to be overseas or not. So that about covers all the things that I wanted to talk about today. Stephanie, I'll turn it back over to you and entertain any questions that anyone might have.
Okay. You know, I just wanted to point out to you that international benefit, that's honestly amazing. I don't know many linked products that have that. So that in itself is a plus. The having the plan of care, having a family member, anyone be able to come into the home, again, that's amazing. That is a huge benefit to have. I did want to point out to that concierge service, just let me know if I'm wrong, but isn't that where they can log in if they're anywhere in the United States and see the father's care that's going on and the testing and everything that he's chosen anyone to be able to see?
Yeah, that's correct. It does offer a care circle in which
I think you went and got, Stephen, are you still there? I think you're got muted. Oh, I think Stephen got muted. Are you muted, Stephen? Well, we'll touch base on that again in a second. But so yes, like I was saying, there is a service that, Stephen, are you there? That you can log in, and as long as the insurer allows, that anyone can see what's going on with the person's care. Anything that they have chosen for anyone to see, pictures, progress, anything that's going on. So this is just another benefit that Lincoln MoneyGuard gives to the families to be in contact. If you're not right there being able to see what's going on with Dad, you can log in and definitely see. It's a huge benefit. I do hear some feedback coming in. So if anyone does have any questions, feel free to give us a call here at AIM. It's 800-672-7202. Stephen, I just want to thank you again for giving us the time. This is a recorded webinar, so if you guys have any questions, just give us a call here. Thank you, guys.